Well, LifeBlood, this is George G, and the time is right. Welcome to today's guest, strong and powerful Jarid Beck. Jared, are you ready to do this?
I'm ready. Excited to be here. Thank you.
Yeah, let's go. Jared is the co-founder and managing director of Risk Management Advisors. They're an organization providing captive insurance, employee benefits, workers' compensation planning. Jared, excited to have you on. Tell us a little about your personal life, some more about your work, why you do what you do.
Yeah, you bet. So right now, sitting in Irvine, California, which is where our office is. We have a nationwide practice, but been in California my whole life, and really the focus, getting out of college was always, I thought I wanted early on to be a investment advisor or stock jock. Got this is 2000, right? So it was the .com, AOL. Was just really infatuated by all of that. But when I started my career, I actually started at Northwestern Mutual, more on the insurance side, which ended up being great. Good training, as I think but quickly wanted to, more so than the personal financial planning, was really more interested in the corporate business to business side of things. So left there and joined up with a firm that was doing that type of planning, and just, really fell in love with that side of the business. And it was a couple of years in there, around 2002, me and my partner that we co-founded Risk Management Advisors with, we discovered, this concept of captive insurance companies, and really started digging into that and found it so fascinating and such a versatile tool. They were like, all right, well, this is what we're going to focus our careers on. And then so it was Christmas Eve, 2004. We founded Risk Management Advisors. And flash forward, but here we are today. So it was really that early interest in finance, financial advising. I did the CFP work very early on, even before I started my career. And then it was, just really, getting deep with with a niche concept that, has served us well.
Nice. Well, having been, I think we started our career around the same time with very, very, very similar companies, which you mentioned. Captive insurance companies, is something that's always sort of been floating around, but I don't know that I really know exactly what it is. Can you tell us exactly what it is?
Yeah, you bet. So at its simplest level, a captive is an insurance company that a business or a group of businesses set up to insure their own risks. So, I'll give that explanation and people say, oh, like self-insurance. And it is like self-insurance to a degree, but it's a very formalized version of self-insurance where you go out, you actually go to a state or a domicile, could be in the US, could be internationally, and you actually go to the Department of Insurance, form a new company, and get it licensed as an insurance company. And said, okay, well, why would you do that? And there's a handful of reasons or motivations for doing so. One of the main reasons is, insurance companies, they get favorable tax treatment under the Internal Revenue Code. If I just self-insure and I save money, well, now that money flows through to my bottom line. I have to pay taxes on that, which, would be fine if there wasn't this potential that, well, just because my tax year ended doesn't mean that, there isn't going to be some loss that occurs and I'm going to end up owing. But, if I've already, I've got after-tax dollars, I'm paying, tomorrow's claim with, less money. It's not the most financially efficient way to go about, carrying reserves. Whereas insurance companies, they can put money into reserves for, claims that we know about today, or, claims that, are incurred but not yet reported, things we don't know about. And then so it gives you the ability to build up, this, a larger war chest to handle, any losses that would come in. And the other advantage is that insurance companies can buy reinsurance, which is insurance for insurance companies. So it gives you additional markets to go to help you lower the overall cost of, of buying policies. So, those kind of the two main reasons. Third motivating factor, a lot of companies are, in emerging spaces, or maybe, there's some tough markets where the insurance is very limited. You can't get coverage for it. And so, setting up a captive allows you to address and provide coverage for, stuff you can't get in the traditional market. So,
Nice.
yeah. And we find a lot of business owners in, especially growing business owners, companies that are growing fast, in high growth areas, or riskier segments of the marketplace, either two or three of those factors are at play. And so the captive, again, is a really nice, versatile tool for addressing those needs.
And what are the needs that the insurance is meeting? Is it health insurance? Is it property and casualty insurance? Is it life insurance?
Yeah, it's situational, but it can be all of the above. So, certainly companies with let's say 100 or more employees that are providing employee benefits or health insurance, that's probably their biggest expense after payroll. Right, you're going to pay the employees, and then the next most expensive thing is going to be providing them health insurance coverage. And unfortunately, for better or for worse, the system is rigged against employers in that, the insurance companies are actually incentivized to pay out more claims so that they can turn around and charge employers more so that they can increase their profit margin. And it's a really unfair system for companies to buy into. They need to have the coverage, they need to offer the benefits, but between what the hospitals want to make and what the insurance companies pay out, it's a system that's rigged against them. That kind of goes back to healthcare reform and the implementation of Obamacare and some of those rules. Done nothing to lower cost. In fact, it's gone the opposite. So what we're able to do with the captive is exit from shelf products and put them into a model where and they don't do it all on their own. We consult with them, but there's tools and techniques for taking control of how claims get paid, and lowering the overall cost of coverage, allowing you to reinvest in the plan, provide richer benefits for your employees. So instead of cutting benefits, you increase benefits, while still again putting more money back in your pocket. So that's on the health insurance side. Again, that's going to be companies 100 and above, that want to offer a nice set of benefits for their employees. Other spots that are really hurting right now, cyber coverage, is you hear a lot about that. And frankly, the traditional market insurance companies can't keep up. The different, methods of attack, evolve more rapidly than the underwriters can keep up with. So there's just these perpetual gaps in coverage. And then they're simultaneously being charged more and more for less and less, coverage. So, we're seeing a lot of companies utilize captives to fill those gaps. Certainly think about construction companies, builders, developers, contractors, just heavy machinery, swinging hammers, a lot of risk associated with that. But, companies with good safety that do the job better than their competitors, they're paying high premiums to subsidize everybody else's poor losses, and they're not reaping the benefits of that. So, and in fact, early on, back during, you were here during this time, I think, during the housing boom, right? Back, 2000, 2002, 2003, 2004, we worked almost exclusively with builders and developers because it was a very difficult market for general liability. You had companies charging, it's called $1.5 million for $2 million of coverage. And
wow,
the builders, they needed to have it so they could get their bank line, so they could get on the project. But, the insurance companies were holding them over a barrel. So, the sharpest guys that we worked with said, all right, well, let's, set up our own insurance company, pay the $1.5 million to ourselves. And then, they would just capitalize or cover the delta there, and kind of fully front that $2 million limit. And then once the policy expired, if they had done a good job and the claims were low, now they get all that money back. So that was a very successful formula, that still exists in certain pockets to this day. But does that give you a flavor for some of some of the implementations you can do?
It does. So why wouldn't everybody do this?
Yeah, good question. One, there is there is sort of you have to be at a certain threshold, for better, for worse. It's not the cheapest, strategy to implement. There are costs, setting up the entity, getting the license. The regulators require you to have an independent actuary create and certify your rates and reserves. Each year, the captive undergoes a financial audit by an independent auditor, just to make sure they're following the rules and regulations and that they're solvent and, can afford to pay the losses for the risks they've taken on. So that adds up to a little bit of frictional cost. And so you need to have a critical mass of premium, to still make it worthwhile. So you need companies of a certain size, which is typically going to be, again, 100 employees and above on the employee benefits side. Companies in that, 750,000 and above range on their liability coverages or property and casualty coverages. So you just kind of, you need that scale for it to make sense. For companies of that size where it doesn't make sense, we'll get a lot of calls. Let's say, George, you call me up and you're like, man, I pay so much for my professional liability insurance. I need a captive to help me lower my cost. They say, oh, okay, well, what do you pay? And let's just say it was $1 million. But then you say, okay, well, send me your policy and then send me all your loss runs. But then we get it in and you say, oh, the losses are actually $1.2 million each year. It's you don't need a captive, you need loss control. You need to figure out why you're having so many claims. And we'll see that a lot on the workers' comp side where, they feel like their workers' comp is expensive and unfair, but then you go to the work sites and it's unsafe. People are getting hurt and, therefore the claims are high. And so they haven't taken those steps to get the losses under control. So it's kind of like, you got to do the foundational work, get your house in order, and then you can have the cool toys.
Got it. Is it possible to get in on somebody on an existing captive, or must I start my own?
Yeah, great question. So what we've been talking about or alluding to really is what's called a pure captive or a single parent captive. And that's where a business comes in, they establish the captive, and it's, they're the board of directors, they're the officers, they control it. It's for their family of companies. But a lot of other firms will participate in what are called group captives. And, this is for companies or businesses where maybe they didn't have quite that critical mass to get their own structure going or justify their own structure. But if they pool together with, 6, 7 other 10, 50, whatever number, like-minded, high-performing employers, then you can build some economies of scale. And then, a lot of those programs will take on new members each year. So, and that can be run on the property and casualty side and also on the employee benefits side. There's a number of successful programs out there for different marketplaces.
And is there some kind of a mechanism in place for the group captive to, obviously you want to do a good job and make sure you're bringing in other companies that are of the same philosophies and quality and compliance and all those? Is there a mechanism to kick people out if they fall short?
Yeah, that's something that's evolved pretty well over time. Because what would happen early on is programs, the promoter or whoever wanted to build it would, they would partner with a carrier to issue policies and then, cover the catastrophic risk. And then they would sort of have a come one, come all attitude about it to build the program up. As you can imagine, that doesn't really work because, again, the bad risk that you let in ends up getting subsidized by the good risk. And, the bad risk people are getting a great deal while the good risk people are getting hosed. And so that led to failure of a lot of programs. So that's what we tell people a lot. You mentioned, oh, why would somebody do it? Why would somebody not do it? The underwriting, or the barrier at entry, the bar is pretty high on a lot of, the better run programs. So, I'm sure in your practice, you see people, send me a proposal and they send you about 50% of what you would need to put together a comprehensive analysis, but they're like, hey, can you just, give me a ballpark, I'm sure you get those guys. And that doesn't, we tell people all the time, that doesn't really work. Everybody wants to get in here. So it's really, you got to put your best foot forward and have, your loss runs, your financials, your presentation of your business in good shape, to get that participation. And yeah, certainly if you melt down over time, then you might be asked to leave. Now that's different from, just having a bad year. And that's why you buy insurance, is to protect yourself from that bad year. So, health insurance side, you're going to have that premature baby, or, you're going to have that transplant, every once in a while. That's what the insurance is there for. And that doesn't get you kicked out of anything. Somebody gets hurt, on the job, building falls over, whatever the case may be. Yeah, that stuff happens, but is it systematic, or is it perpetually happening? And that's the type of stuff that, if you don't keep your house in order, then yeah, you may be back in the traditional market before long.
So what is the typical discovery process, or what does yeah, what does the typical process look like? People who are listening and say, you know what, I've got a couple hundred employees, and yep, my health insurance is my number two biggest cost. How do I explore this?
Yeah, usually, if it's we'll have financial advisors, property casualty brokers, benefits brokers. They'll call us up, and it'll just start with the, hey, I got a guy, conversation. It's the, hey, this is my client. What do you think? And then, if it says, I don't know, it sounds like there's some things we can do here, then it's usually a educational or, introductory call with the client, talk through a lot of what we're talking about here. This is what a captive is. Tell me about your business. And then, if we decide it makes sense to move forward, we have what we call a preliminary feasibility study, where we would collect some basic information, copies of policies, basic company information, revenue, number of employees, et cetera. And we'll prepare a report that, says, hey, these are the strategies that, you could potentially implement that you would benefit from. And we come back, we have a discussion about that, and, and evolve it from there. The education part is key, because, again, the concept of a captive, pretty simple. That takes 12 seconds, but it's, the different paths you can go down. And if we're going to do that, we want to make sure there's something there, for the client at the end of the day. There's also the different approaches. And again, we'll have people come in, I need a captive. Well, it's all right. Well, what does that mean to you? Because, the concept will mean different things to different people. So you want to make sure, what you're going to deliver in the proposal is meeting up with what they want to get out of it, because we'll have people, it could be a great strategy for, again, let's say addressing gaps in coverage. It's like, hey, you've got, here in California, employment practices liability insurance is very difficult because it's such a litigious state. Employment practices claims can actually blow up into class action lawsuits out here. So we're seeing, and the way the law is written. So, if you have one employee that says, oh, I didn't get my break, they can hire an attorney. And then if they find one other person, they'll now take it as a class action, and they'll assume, well, if you did it to that one person, you must have done it to every employee that's ever worked at that company. And now all of a sudden you have a class, gotta love it. And the insurance isn't priced to address that. It's a price to address like the one-off situation where you messed up and you wronged somebody. It's not priced for class action stuff. So, a lot of times we'll make that recommendation as, hey, a captive would be perfect to address this class action exposure. But maybe that doesn't move the meter for them. Maybe they're in it for, they want to save money on their workers' comp. And so it's, again, identifying, kind of the basic, even going back to the basic tenets of financial planning, 101 is like, hey, what are your goals and objectives, and what are you looking to get out of this? And then, making recommendations around that, even if it's, hey, this isn't going to work out for you, but, here's what would, and, at least they took a look. But,
Love it.
Yeah.
That makes sense. Well, Jared, I appreciate you coming on and educating us on captive insurance companies. Probably a long time coming for the show. Where can people learn more about you and risk management advisors? How can they start the conversation?
Yeah, I really enjoyed it. Thank you for the great questions. So we have a YouTube channel. You can find us on YouTube. A lot of great content there. There's also a lot of good video and downloadable materials on our website, which is www.riskmgmtadvisors.com. And then Facebook, Instagram as well.
Well, if you enjoyed this as much as I did, show Jared your appreciation and share today's show with a friend who also appreciates good ideas. Find Risk Management Advisors on YouTube. I'll link that in the show notes, as well as go to riskmgmtadvisors.com.
That's right.
Excellent. And then the other social media locations as well. And I will be sure to link those in the notes also. Thanks again, Jared.
Awesome. Thank you so much, George.
And until next time, remember, do your part by doing your best.